This is the Friday, June 5, 2020 version of the Market Plus segment. Joining us now, Mr. John Roach, Senior Market Analyst of the program. John, the in thing to do when you do these remote things is to ask if you're wearing pants. You are. I gave you the option of the yacht look, but you look like you're ready for business. How are you doing in all of this? You've kind of been at home there for a while. Are you getting ready to bust out, or are you okay hunkered down?
I'm okay hunkered down, but I'm ready to bust out. I've been in home arrest now since March 12th, and so it's been a while.
And you told me this week the last time you had gotten out of the house on a trip was when you came up and saw us, and that was Valentine's weekend. So it's been a while. Yeah, and so you haven't been traveling. One of the things is you've been making a lot of food at home. I've been making a lot of food at home. So is everybody else. We're using a lot of cheese, and that is one of the reasons we're hearing about the dairy market going up. We got a great question from our viewers here. Corey in Iowa is asking you, John, what fundamentals have caused milk prices to rise from $12 for the May contract to $20 for June? Also, what recommendations would you suggest for risk management of milk prices for the remainder of 2020, if any?
Well, the reason that we've had first of all, you have to look and see why we had the down, and that was because of supply chain. There's only so many places that you can go, and once you run out of places to go, then you start dumping it. And of course, before you do that, the prices really get cheap, and that's what we saw happen. The market bottomed, and we started to recover. And I'm surprised by how fast it's come up. But it's all the products, and the only one that really just lately has taken a down swing is the dried milk, the powdered milk. Otherwise, everything is right up at its top, and I don't have lots of reason for that other than to say that we've gone through the shortage problem or through the surplus problem, and now we're starting to restock and get ready to open back up again. And we found the demand was maybe a little bit better than what we thought during the period that we're all cooking for ourselves.
This is going to be a temptation for some, and that is to restock herds. Are you thinking, suggesting, recommending that as an option right now?
I think most dairy producers are just happy to be able to have the price come back up. And the idea of investing more money into the operation this quickly, we're not that confident yet in the future. And if I were a dairy person, I would be looking at the hedging opportunities here. This is a pretty good rally. You got to take advantage of these kind of rallies.
Okay, do some hedging there. All right, one of the things you like to do, John, is talk some cycles. We know you study things. You've done this a couple of years. We got a great question from Glenn in St. Francisville, Illinois, and he's asking, seems like the long-term down cycles in ag last about 7 years before building a base and returning to more profitable levels. Are we near a change in trend? And if so, how do I position our farm to take advantage of these, hopefully, more profitable times?
Interesting enough, we were supposed to be in the upward side of the cycle right now. I mean, there were quite a few people here 6-8 months ago were saying that the last fall lows that'd be a bottom of a cycle, and that we would come from there and move higher. And of course, then everything went wrong with that situation with the COVID and the people staying home, et cetera. So we're just having to get through that. The only thing that people should understand is April was the low, and so there's a low mark. And it's coming at a time when you normally have kind of high prices. And that's another thing that happens when cycles reverse. They tend to bottom at a time when you normally have high prices and peak when you have low prices. And we had a bottom in April. That's a very unusual situation in grain market. So I think that the thinking about a cycle bottom that we come ratcheting up out of, I think makes sense. Now, the thing you want to be careful about is that it's going to take something fundamentally to cause that. That doesn't happen just magically. It's something goes wrong fundamentally. Demand's bigger for one reason or another, or we have a crop problem, usually is the situation. We don't have that today. It's possible we could develop it, but we don't have it today.
Is there any way to position yourself? I mean, you can never really predict for the unknown, but how do you try to ensure some type of profit
Go do the things that you know make sense. And the first thing right now that farmers should be doing, if they haven't, is they need to get their interest rates figured out. They need their long-term borrowings fixed to these low price levels or these low interest rate levels. And that of all the different things you could do out there, if you secured the financing, your long-term financing for the rest of your career at today's level, it would make you more money than anything else I can think of. So get your long-term financing put together. Hopefully you did that when the PPP program was being offered and you were able to get some government assistance in your long-term financing. That to me is where the best deal is right at the moment. The other thing that I suggest farmers do is don't try to look out a long distance and feel like that you're standing on a perch. You're not on a perch of any kind. You can't see anywhere. We're in a hole still. We're still in the well. Maybe we're sticking our nose up over the edge of the ground and we can see out of the well now, but we certainly can't see the future. And what my suggestion is that we're all too pessimistic about what the demand's going to be out forward. If we were to lay some long-term demand graphs down, you would say, well, gosh, these demand levels that we're dealing with right now are really low levels. They're really poor levels.
Okay.
And we'll come out of that.
You hold that thought on 2021 because we're going to talk about that in a minute. I know you were telling me about that earlier this week, but I need to kind of follow up on something you said here earlier when things are turned around. Historically, as Phil in Ontario, Canada, the state of Ontario, the province there, and you're Dresden, Phil's asking, historically, mid-June, John, is a good place to price new crop corn. This year, December corn is at $3.43. Where will the pricing opportunity be going forward, or is it in that rear view mirror? You talk about normally we see something at this time and we're not. So how do you answer that question?
Well, the several different ways to answer the question, but you've got to look at this price level here and say, okay, where is it relative to where we've been? And for most people, the corn price, and certainly the bean price today, but the corn price is almost as high as it's been now for the last 60 to 90 days, maybe, just kind of depending on where you're located at and what the basis levels are. Basis levels have been very good. The problem is that we can't make up for the lost demand that occurred when we all quit driving our cars. We can't go back and get that ethanol and use it. We're only going to use it as we go forward. Now, the good news on ethanol is that we're no longer have a big inventory. We're down to normal size inventories. As we ramp up the consumption, we're going to have to ramp up production. So that means there's more demand coming out forward. But that being said, we're going to get a sell signal this next week on corn, and we're going to sell a little bit of new crop corn, not a lot, but a little bit, because that's the right thing to do. We'll look for places on a buy signal to buy some of it back, carry it into the spring of 21.
All right. Still, hold that 2021. You're getting out of order. I've only got these in a certain order, John. I got to talk about the dollar because that's also a little bit of a factor here. Jeff in Madison County, Iowa was asking me if the U.S. prints another trillion or two, I think he's talking about another stimulus there, will we see some weakness in the dollar?
Well, the interesting thing is that as we've printed lots and lots of money, the dollar's gotten stronger. So the cause and effect is not quite that way. Actually, what's happened is a lot of people who've had money overseas needed to turn it into dollars in order to come buy our stock market. And I think that's the part of this equation that people are not thinking about. If you had lots and lots of money, lots of cash, first of all, in some marketplaces, it costs you to deposit the cash. In other words, buy a government T-bill, you spend $100,000, and in 90 days, they'll give you back $99,500. So that's one investment opportunity that you have. Or you could buy an equity or something else in some other country that's struggling, and who knows what the situation is going to be with the COVID. I mean, so there's a lot. And instead, what people have done is they've come to America and they've bought the U.S. stock market. And so what's running here is the stock market, and that's also causing the dollar to run because you've got to convert your currency into a dollar in order to buy U.S. stock market.
Well, there's a theory, and it kind of goes back to one of the things you said. If we're in the hole, we're not on the perch yet. We're following some of the roadmap that we left in 8, 9, and 10, where a lot of people were buying in April and early May in that stock market at the lows because they just anticipated and felt the optimism going forward. So the question now is, we had negative oil in April at one point, but Brian in Marseilles, Illinois, Marseille, is asking, WTI crude has been trading higher and higher, but the question is, do you think we'll see mid-50s per barrel again in the future?
No, in the future, yes, absolutely. In the future, yes. How quickly in the future? Don't know.
Don't know.
You've got two different things working here. One, you have OPEC, which is trying to get the price up, and two, you have Americans that are starting to drive, and maybe even other people around the world starting to drive more. And so that's hold back on supply, increase a little bit of demand. We could certainly have the market move a little bit further. How far it goes, I never know. I never know that. And I couldn't believe that it was trading, below zero either.
Right.
I mean, sometimes these markets are just, they're really forced to do things that surprise people.
All right, finally, let's talk 2021. Let's talk about the future. Let's talk about supplies. If 2020, from Bradley in Upland, Nebraska here, says if 2020 doesn't see a 2012 size drought, how will the U.S. chew through 3.3 billion bushel corn carryout number in 2021?
I don't know, but let me also suggest that none of us knew how we were going to chew through 1 billion bushels of soybeans. But you realize that with our markets hammered, we chewed through 1 billion bushels of soybeans. So I don't know how we ever bring our supplies down, but we always seem to. And so what you have to think about for 2021 corn is, okay, that means I have the summer of 20 in North America. I have the summer of 20 to 21 for South America. And I come back to the summer of 21 for North America before I have to sell that corn. I have 3 crop years. I'm not going to bet that all 3 crop years are going to be excellent. And my suggestion would be that unless you can make a lot of money selling 21 corn at this price level, don't do it. You will have lots of opportunities to sell at a loss.
There's some people who say they're pretty good at that. The 21, I look at this though. You're talking about 3 years. Let's go last year, 2019. We had wet everywhere, it seemed. And we still put an average crop, if not trend line, into the bins. And we were poor. And that didn't seem to create much of a problem. So is it going to have to be a drought only and not a washed out? We got people near Champaign, Illinois telling us that they're wetter this year than they were last year. So is it going to have to be drought only for a weather situation or something else?
I don't know.
I asked 12 questions. I know, John. I know.
Paul, the thing that farmers need to think about is that prices go up because we're worried about the crop, not because we lost it. We're worried about it. Last year, we were worried about it. I mean, we were really worried about it. And in the midst of that worry, it was a good sale. Okay, so now where are we at? We're not worried about anything. In fact, if we're worried about so much. We're worried about 3 billion bushels of corn. Okay, and yet that farmer has 2 crop years. 2 years he has to raise before he can deliver those bushels.
Good points.
I think I'd be patient.
Patience is a virtue I don't have, John. I get a little, antsy all the time.
If you have to do something, let's just look. You have corn in the bin. Okay, now you have to do something here. When we get a sales, you've got to make some sales. That's a different situation than 21 corn.
Good point. That's why you're a senior market analyst, John Roach.
It's just because I'm old.
You said it, not me. You look great. Good to see you, John.
Thank you.
All right,
Appreciate it, Paul.
That'll do it for Market Plus. Next week, we will break ground on the return of a crop for the first time in decades, and Naomi Bloom will be here to analyze the markets. For John Roach and the rest of us here at the Market to Market television program, I am Paul Yeager. Thank you so very much for watching, listening, or reading. Have a great week.